Welcome to Consultants and Money, the podcast for solo consultants who want financial clarity without the overwhelm. I'm your host, Erica Goody, CPA, bookkeeping, and CFO partner, and a fellow corporate ship jumper who built a business with balance in mind. Each week, we talk about the real money stuff, from keeping your books clean to calming cash flow chaos, saving on taxes, and planning for what's next, so you can focus on your clients and enjoy your life. A quick note, this podcast is for educational and informational purposes only, not financial, accounting, or legal advice. Be sure to talk to a professional who understands your specific situation before making any decisions. Hey, and welcome back. Today we're talking about something no one enjoys: surprise tax bills. There's nothing like thinking you've got everything covered and then opening an email from your tax preparer in March or April and seeing a number that makes your stomach drop. If that's happened to you, you're not alone. And the good news is it doesn't have to keep happening. So today I want to walk through why those surprises happen, how tax estimates actually work, and a few simple things you can do to get out of reactive mode for good. Let's dive in. So let's start with the basics. Why tax surprises happen. When you're an employee, taxes are withheld from every paycheck. When you're a business owner, that doesn't happen automatically. So unless you're running payroll for yourself, if you're an S Corp, or paying quarterly estimated taxes, there's a good chance you're racking up a tax bill behind the scenes as you go. Most surprises happen when you're not paying those quarterly estimated taxes, or your profit increases, but your tax plan doesn't change, or you don't understand how quarterly estimated taxes work, or something in your bookkeeping is off, like your owner draws are showing up as expenses, which make your books look less profitable than they really are. All those things are fixable, but if no one tells you to look out for them, it's easy to get caught off guard. And honestly, even smart, successful business owners get surprised because no one teaches this stuff. I have 2 business degrees from a good college, and I swear they never taught us this. So what does safe harbor actually mean? This is something you might have heard from your tax preparer. Safe harbor. It just means if you pay enough in estimated taxes based on last year's return, you won't get hit with a penalty, even if you owe more when you file. So for example, if you owed $20,000 in taxes last year and you paid $20,000 in taxes this year, you've met safe harbor. That protects you from underpayment penalties. But here's the important part. Safe harbor does not mean you won't owe more money. It just means you won't get penalized. So let's say last year you made $100,000 in profit. And this year, business booms and you make $200,000 in profit. If your tax payments were based on last year's $100,000, then yes, you're penalty free, but you still owe taxes on the extra $100,000 in profit. If you didn't set aside extra money for the taxes related to your increase in profit, that's when the surprise hits. So in other words, if your tax preparer gave you tax estimates based on last year's profit, and you're paying those estimates based on last year's profit, and now this year your profit doubled, you didn't increase your tax payments, so here comes the surprise. So the safe harbor payment is a helpful minimum for not being penalized, but it's not a substitute for tax planning. Now, here's a golden question I get all the time, and everybody asks this. How much should you be setting aside for taxes? What percentage of your profit should you be setting aside? This is a general answer. A good rule of thumb is between 25 and 30% of your profit. That's net profit, not revenue. So income, money coming into your business minus expenses, money going out of your business. And again, this is general advice. This is not specific to you, the individual listener, who might have no idea your tax situation, because that range isn't a one size fits all. Your actual tax rate depends on a few things: Number one, your total household income. If your spouse also works or you have another income source, your combined income might bump you into a higher tax bracket. Number two, the state you live in. If you live somewhere with higher state income tax, like California, New York, Oregon, you'll owe more. And if you live in a no income tax state like Texas, Florida, Wyoming, your tax rate might be lower. So if you're just getting started, 25% is a reasonable place to begin. But if you're earning more or living in a high tax state, 30% might be safer. And yes, it's a great idea to always check with your CPA mid-year to tweak that number and make sure you're on the right track. Here's another common question. Do you need a separate tax account? This is logistical. Some people swear by having a separate savings account just to put their tax payments into before they make it. Here's a nod to the profit first people. They move money into a different account every month and don't touch it until they pay their taxes. That is absolutely great if that is what works for you. But you don't have to have a separate tax account. If you're someone who's naturally conservative with money and you're not going to spend cash that isn't yours, it's okay to keep it in the same main account you have everything else. The key is knowing it's not yours to spend. That money is the IRS's, and you're just holding on to it and hopefully collecting some interest on it until it's time to pay your estimated quarterly taxes or your year-end payment. So do whatever makes sense and easiest for you to just leave that money alone until you make the tax payment. Now, how do you get ahead? How do you make the surprises stop happening? Here is your anti-surprise toolkit. Your clients get the best of you when your finances aren't a roller coaster. I work with solo consultants to create W-2 style consistency in their take-home pay, no matter how unpredictable business feels. It's easy to get started. Visit ericagoody.com, complete the connection form, and we'll schedule a free, no-pressure meeting to talk through your goals. I'll leave a link in the show notes. These are simple, but they work. Number one, track your profit monthly. Revenue is not profit. Look at what you're actually keeping after expenses. Number two, set aside taxes consistently. Move 25 to 30% of your profit each month into savings or just mentally mark it off limits. Number three, review your numbers every quarter. Ask yourself, did I make more than I expected? Did anything big change? Do my tax payments make sense compared to where my business is? Number four, ask your CPA questions before tax season. You're not expected to know all the rules, but the earlier you ask, the more time you have to make a plan. Now, your CPA might charge you for this, and that's okay. This is money well spent. None of this is about being perfect. It's about being proactive. Here are some of my final thoughts on this. Taxes are always going to be part of running a business, but the feeling of being blindsided every spring, that part is optional. You can't control everything, but you can stop guessing. You can stop waking up in a cold sweat over your tax bill. And you can move from reaction mode to readiness with just a few steady habits. Thanks for joining me today. If you found this episode helpful, share it with a fellow consultant who might need it too. And until next time, here's to cleaner books, calmer cash flow, and more time for what matters most to you.